What is up, YouTube? Welcome back to Stocks by the Numbers. Today is Friday, the 13th, incidentally. But I wanted to talk to you real quick about a financial institution here that posted earnings this morning. I'm sure you guys are very familiar with this name. We're talking about JP Chase here. Ticker symbol JPM listed here on the New York Stock Exchange. Company posted earnings this morning. They actually beat earnings. And as you see, out of the gate, down a few points and then slowly rebounded and went green, sitting here. Closed out $143 a share, up about 2.5% on the day. Now we're sitting here with a market cap of about $420 billion. We have a PE of about 12, which looks attractive, and we're getting paid a little less than 3% to own shares of the company. And basically, this company, as it says here, largest of the big four banks, the firm is considered systemically important by the Financial Stability Board. Its size and scale has led to enhanced regulatory oversight as well as the maintenance of an internal fortress balance sheet and liquidity reserves, right? Okay, all of that is nonsense. What that all means, too big to fail. Right? So we switch it up. We pull up a max chart. Here we go. As we see here, shit hit the fan because these specific financial institutions themselves got too greedy and kept investing their profits into ridiculously high speculative fucking plays, and basically, again, the shit hit the fan, and we had to bail them out. So the stock goes from 40 and change down to sub 20, and then rebounds back into the 40s, but as you see over the years, makes some serious climbs. And this is why I talk about holding an investment for 5, 7, 10 years, especially if they pay a dividend. Because if we turned around and I said to you now, oh, your principal investment is up 150%, so your 100K is worth 250K, but you did a DRIP, DRIP, which is dividend reinvestment program, so you kept reinvesting into more shares of the stock, so now you really have like 350,000, not necessarily, 250,000. It will be slow, it will be uneventful, but it will be more of a stress-free investment. And again, you could potentially turn around in several years and say, hey, now I got a nice little chunk of change here, let's buy a house or start a business or whatever it is you might want to do. But, even quarterly, we can see that this company has basically been maintaining like this $30 billion mark. And if we switch over here annually, again, 2017 sub 100 billion, then they broke the 100 billion mark, maintained it for 3 years. 2021 almost 131 billion, $420 billion market cap. So comparing that to the 2021 revenues, this company is trading a little over 3 times annual revenue based on 2021. For this year, if we add up these 3 quarters and the most recent one that they posted, I believe I got 125 billion. So they had a slight dip here in the revenue from 21 to 22. However, still making some nice income off of that. And of course, still trading at about 3 times and change to 2022 revenue, which, as we've seen looking at a lot of other companies, could technically be viewed as undervalued. Also with the PE of 12, making this very attractive in my opinion, especially in the long term. It says here they set aside $1.4 billion in case of a mild recession. First of all, I have to say this is like a rainy day fund, right? This is basically what the average business owner does. You skim a little profits off the top, you put it to the side just in case you get hit with, back taxes bill, or if, God forbid, a piece of machinery goes down or equipment, you have to replace it immediately. That way the business doesn't skip a beat and you keep your customers, your clients happy, right? So this is not anything new. However, I will say in anticipation of a mild recession, I do have to give Jamie Dimon a little bit of my credit here, even though I'm sure he doesn't care about it. But I feel like he is like the only guy on Wall Street who is consistently mentioning this word recession. Everyone else tries to make it act like it's not going to happen. You shouldn't think that way. You're right. We have all the bases covered. Don't worry about anything like that. Meanwhile, Jamie Dimon over here is like basically every other quarter is like, yeah, I think we might run into a recession. I think we might have a recession here in this country. So I got to give credit where credit's due, right? At least he has the guts and the balls, if you will, to talk about what could potentially happen to the company, right? But again, earnings very quickly posted $357 a share, estimates $307. They beat, posted $34.5 billion plus. Estimates were $34.3 billion, so they beat over there. Again, look at the revenue growing quarter over quarter. 30, 35, 40 billion, and I know the profit margin sold off like 1.2%, but again, they're skimming profits off the top. So to see like a 1% drop in profit margin when I'm seeing these type of increases in revenue, really not raising a red flag for me at all. And of course, if we look at this trend, if this didn't happen, they most likely would have continued going up and up. So this company is basically just refinding its footing to basically take another leg higher. And if we look at the financials, here they are very quickly. We switch over to annually, and I just want to show you guys again, look at the PE, basically maintaining double digits, as low as 10.3, as high as almost 17. Right now it's at about 12. So, this PE could easily climb to 14 to 15 and still stay in this historical range. And of course, now we'll be looking at a stock that's, $163, $168 a share as opposed to $143. So we definitely have some potential here to keep rising. The price to sales right now, basically, again, in the historical range, sitting at about 3 times sales. The cash flow has been bouncing around and volatile over the years. Last year was 10 times cash flow. Right now, it's about half that, sitting at about 4.5 times cash flow. And look at the book ratio here, price to book. 1.6 times book value. So the book value of JPM right now is about $88 a share. Stock's trading at $143. This is why I talk about finding, financially sound, stable companies with healthy balance sheets that could technically be viewed as undervalued, right? They're trading a little over 3 times yearly revenue, which when compared with other companies we looked at on the channel is undervalued. They have a PE of 12, which according to their own history, and of course some of the other companies that we looked at, could be viewed as undervalued. They're trading 1.6 times book value when you have companies like Mercado Libre that we just looked at that said should hit a resistance level and pull back to come back down to earth, and what happens? It pops another 5% and continues to widen that ratio of price to book, now probably trading 30 times its book value, and you have a company like JP going back 150 years in our history, and they're only trading 1.6 times book value. So yeah, you better bet your bottom dollar I'm seeing many metrics that are indicating that this company could be trending higher. Return on assets, again, same thing, basically like 1% in change throughout the years, sitting at 1%. Return on equity bouncing around again, probably the median average of these numbers is probably 12-13% maybe, and that's where it is right now, 12.7. Return on invested capital, between 4 as high as 7%, jumped up to 8.3%, pulled back, still above 6% here at 6.1%. Operating margin, again, these numbers bouncing around, really not raising a red flag in my opinion. As low as 20, as high as 46. Now it's about a little on the bottom end, mid-range of that at 29.25. And we looked at the net margin percentage before, obviously bouncing around, but basically always stayed above 20%, did have a nice spike to 38%, but still sitting at 23.5%. So that's why even seeing some of these slight volatile pops and drops in some of these numbers, that is really nothing to write home about. Switching over here on the daily, on stock charts, we see that the RSI is now above 70, so we could potentially run into a little bit of a sell-off here Monday, Tuesday, and have some flattening or potentially a pullback. We have the mid-Bollinger Band and the 50-day moving average respectively, both climbing, basically diverging almost at a similar price here. The mid-Bollinger Band 133.80, the 50-day moving average 132.88, and it looks like it just had a recent healthy bounce off of that level. So that right there is going to be your support, in my opinion, about the low 130 range. MACD still rising, so we do have potential, but again, pretty high RSI, so we could have a little bit of a pullback. Even on the weekly, the RSI here at 66, so it's approaching 70 with the top Bollinger Band here of 147.81. Now, of course, widening on the top and bottom as we had these pops upwards. So we could have the potential early on Monday morning to pop up to 147 or whatever, and then pull back. I don't know if it'll come down this low, but again, start to pull back just a few dollars just to cool off the RSI on both the daily and the weekly. But again, here we have the middle Bollinger Band meeting up with our 50-day moving average, 123.98 on the 50-day moving average, 124.36 on the middle Bollinger Band. So on the weekly, that right there, in my opinion, is your support about the 124 level. MACD, of course, continuously rising along with the stock. So 124 support on the weekly, and switching back to the daily, you have about the 133 support. So again, it has been on a little bit of a tear. So if you want to wait till Tuesday, Wednesday for a potential pullback to maybe like this 137.5 mark, or even if they really do pull it back, which they really shouldn't in my opinion, but let's just say they pull it back to, sub 140. In my opinion, I would consider stepping in and potentially grabbing a couple of shares at that discount because, again, overall, in my opinion, the business looks pretty healthy. And even though they do potentially keep warning about, a potential negative mild recession, this company, again, is doing decent business. They just put aside, 1.4, 1.5 billion just in case the shit hits the fan. So it really seems like they're being a little bit more conservative and a little less cavalier than they were in the past. So, it does seem like, a decent company overall here at these levels. Again, we did just have a rise, but I will say, even though this was a pandemic, I will say, we have these big rises, and then we have these drops, which are basically buying opportunities, in my opinion. Re-rise is higher than it was, and then we have these drops. So historically, if this happens again, it's going to re-rise higher than it was here at 170 tops, and then have a pullback. So it will most likely run to north of this 52-week high, 161, make a new 52-week highs, new all-time highs, probably in the 170s, potentially 180s, and then have a pullback. But overall, in the long term, I do have to say, in my opinion, I do like this company, JP Chase, and there are far more speculative plays for you to invest into that are going to cause much more stress and much more heartache. So why not buy a brand name company like this, right? But I'll leave it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop them down in the comments section. Just like everyone on YouTube says, if you like the video, give it a thumbs up. Helps out the algorithm. If you like my content, consider subscribing to my channel. It means a lot to me. But overall, moving forward, like I always say, it is Friday. I want everyone to have a stress-free, happy weekend. Enjoy yourselves. And again, like I always say, I know markets are volatile and rocky and uncertain. So I wish everyone success. I hope everyone makes a couple of dollars. And I'll see you guys in the next video. Take care.